Hello everyone, welcome back to my channel. I'm your host Miss KK and this is The Wave. So today we are going to be debriefing the knowledge quiz, which we normally do on our Instagram page every Friday. So if you haven't done so, please follow us on Instagram, which is Money Matter with Budget B. And every Friday I put out a specific quiz on a topic that I want us to discuss. And it's normally multiple choice question with 4 options, and obviously Instagram will tell you whether you're right or wrong. But the aim of this quiz is not to actually see who is actually ahead of the game or whatever. It's just for you to actually look at where you are, and if you're getting these things constantly wrong, maybe look up a book, look up a Google article, or maybe actually watch a YouTube video that I've actually done on the subject matter. So I try to make sure that I sort of do things that I've already covered, so that the people that are actually watching the video can actually see where they stand in terms of the knowledge gap, and the people that didn't watch the video can actually then maybe identify an area of need that they are willing to invest in. So the knowledge quiz that I'm debriefing today is the one I did on insurance. I think it's from 2-3 weeks ago. Yes, I'm behind with my schedule, but I'm trying to catch up with the video so that I can actually do debrief these quizzes on time. And the reason why I'm bringing up insurance is because it's very topical at the moment, especially with the death brought about Corona last year, where we were losing family members suddenly, and then you're starting to think, was I actually adequately providing for my family before that? Can I actually afford to leave my family today? Have I provided for them in an event they depend on me when I'm no longer here? And so many other considerations or thoughts that are actually going through our minds, and that's why I'm actually doing this. So there are 5 questions. I have my book here because it's multiple choice questions, so I won't be able to remember all the options on top of my head, but I'm going to be putting up the questions on the screen as well as the results, so that you can see how many people were actually getting it right and how many people were actually getting it wrong. And I'm also going to be explaining why certain options are correct and why certain options are wrong, because I don't generally just put random things there. I put things that are sort of interlinked so that I can see if you actually understand the key distinction between certain things, and that is where we are coming from today. So the first question was around insured events, right? Any insurance contract is written in context of an insured event. It can be a life insurance, it can be a travel insurance, it can be a life household content insurance, it can be a house insurance. So the context in which the insured event in which the insurance cover is written is what is likely to either result in a payout or a payout denial when the insured event happens. So you can't then now take a life insurance and want to claim when your car is bumped, because the insured event in a life cover is your death, and the insured event in a car cover is an accident. So you need to be able to ensure that you understand the insured event of the insurance cover that you're signing up for, so that when the insured event happens, you're actually putting in a valid claim, and you're not putting in a claim that will result in being disallowed by the insurer, and then you're going to be writing Instagram posts that, you know, this and this so company is actually bad, they're not paying your claim, you've been paying for so many years, etc., etc., when in the meantime you're actually claiming the wrong insured event under the wrong contract. So I actually now had a question to say that insured events are normally written in context of the contract. So which of the following is unlikely to be an insured event in a life cover? And I had option 1, terminal illness, option 2, disability cover, option 3, a job loss that has resulted in you not being able to pay your debt, and option 4, funeral cover. And I'm actually proud of my crowd here. 99 people actually ticked the right answer. Job losses is unlikely to be an insured event in your life cover. Most of the time, life insurance would include a component of terminal illness, would include a component of disability cover, and would include a component of of funeral cover. What you need to actually understand when signing up for a life cover is you need to be actually in a position to decide what portion of your benefit are you going to be allocating to these various items in your life cover. So for example, I do know, like, the life cover I had, standard funeral cover in a life cover is like 100,000, but you really need 100,000 to actually bury someone? Technically not. So you need to be able to interrogate what portion of my benefit is going toward the various components that are sitting in my life cover, and am I comfortable to actually pay that much money in an event that happens. So you need to make sure that you're not putting a disproportionate money of your cover to funeral cover, for example, when you are trying to take this life cover to provide for your family someday when you're no longer there. So that was the first question, and I'm glad the majority was the correct answer. The second question that we had on our Instagram page is around credit life cover, and most of the banks in Namibia require you to have credit life so that when you die at some stage, they don't have to come and repossess your house, they don't have to come and repossess your car. They can just put in the claim to the insurance company. The insurance company will pay out the cover amount, and whatever is left is then paid over to your beneficiary. So my question here was, at what point can you take out this life cover, or which of the following is actually not true? Number one, you can cede a portion of your cover. That's actually true. And you can also cede it to multiple lender when there is enough money. So if you have a 1 million cover, you have 200 debt with lender A, 200 with lender B, you can cede that same life cover to those lenders because that cover is enough to cover those two debts. Yes, you can cede a portion of the cover. You don't have to cede the full cover. So that is correct. So 3 and 1 is correct. It needs to be taken out at the same time as the debt. That is the false answer, and that was the correct answer. You can take out a life cover today, or you can take out a credit life today and then take out the debt in future. It doesn't need to be taken out at the same time. And this is with this whole Nafisa update to say that you can see one cover to multiple lender is actually a good thing for you guys to go and revisit your insurance cover and say, do I maybe have too many covers? Or can I cancel some covers and cede a portion of my existing cover to this multiple lender? And the last one is a cover can be cancelled and a new one can be taken out to cede to the lender, or to the lender that you had a debt with. So that is also true. So you can, yes, cede one cover to multiple lender, cede a portion of your cover to a lender, cancel an existing cover and take out a new cover to actually act as credit life for that debt. It's not a requirement for you to take it out at the same time. So that was question number 2. Question number 3 is updating life cover beneficiary. The one thing that a lot of us don't think is there's normally events in our life that are changing that may necessitate us to actually update our cover amounts or beneficiary. So I actually just wanted to actually provoke some thought whether you need to maybe check out if you need to go back to your beneficiary, or you need to go back to your cover amount to see if it's maybe necessary for you to actually update this amount. So I said, which of the following event is likely to trigger you in actually going to take out a new cover? So number 1, getting married. Number 2, getting a child. Number 3, switching job where you had a group life cover. And number 4, all of the above. So actually all these events are events that should trigger you to go back to your amount, to your insurance cover, and see whether you actually want to update the amount or you want to update the beneficiary. So let's think about getting married. If you get married, you now have a significant other, so you might want to see whether the people that were there as beneficiary are still appropriate, or you may want to put your husband or your wife as a new beneficiary on your cover. Getting a child, yes, you might want to cede a portion of your insurance cover to your children, or you might want to actually increase the cover amount because now that you have kids, you no longer can actually afford to keep the same amount. Switching job that have group life cover. So sometimes we don't have adequate personal cover because we are relying on our employer to actually cover us for when something happens while we are still in employment. So if you are switching to a job that doesn't have group life cover, you might want to think back and say, is my personal life cover that I'm taking out in my personal capacity actually sufficient for me to be able to still want to provide for the people that I'm trying to provide off with my cover? So basically all these 3 incidences will actually require you to update your cover amount or your beneficiary amount when any of this have happened. So, and I had 125 people that actually got this right, so I was quite impressed as well. Then the 4th question that we have was actually around affordability and when can you cancel a cover and actually expect to get some money back. Because a lot of people, yes, they say, yeah, I don't like paying insurance because I'm just losing money. So what I actually want you to understand is insurance is a risk product and not a savings product. Of course, unless there's a saving element to your insurance product. Some insurance actually have cashback elements where though you contribute a portion of money, and every 5 years you get your money back, for example. So that is a specific feature that they add in the product, but you're actually paying for that feature, but you're actually not saving with an insurance product. So insurance product are risk product and not savings product, so you must distinguish the two. So I was asking, in which of the following instances would result in you actually getting a refund from or getting a claim from the insurance cover? Number 1, if you decide your cover is too high, you're going to cancel it. That is actually not correct because remember, it's not a saving, it's a risk product. So the insured event didn't happen, you just canceled the cover. So if you decide it's too expensive, tough luck, you don't get anything out of it. Number 2, you had a car for 5 years or so and never had an accident. Again, the insured event in the contract was an accident happening. You never had an accident. So even if you paid for 5 years and you never had an accident, you won't get anything if you decide to cancel, except if insurance company are trying to incentivize them to stay with you, where they say we will lower your premium or we'll give you a lump sum after a certain period of being with us without insurance. But they are doing that to encourage responsible driving, because responsible driving just means for them low claims. And then if you are retrenched and can no longer afford, yes, if you are retrenched and can no longer afford, it is a valid reason why you must cancel your contract, your insurance, because if you don't have money to pay the insurance contract, what must happen? But even that is not a valid reason, because the insured event in that contract wasn't retrenchment, and therefore you are not entitled to receiving money from this insurance company. So then that means that leaves the last option, which is none of the above. So that was option number 4, and 86 people actually ticked none of the above, so I was super proud for them. And lastly, we are on to question 5, where I asked who of the following will get a payout on your life cover to the extent they are listed as beneficiaries. So we said it's your kids, it's your wife, it's your ex-girlfriend who you listed as the sole beneficiary on your insurance product, and it is your godparents. And this question caused up a bit of stir, and people are saying, no, doesn't that depend on the marital regime that you are actually married in, whether you're married in community of property, etc. But the reason why I brought this question up is the insurance company is likely to honor who is listed as a beneficiary on your insurance product. So if you list your girlfriend as a sole beneficiary and you put it on when you were dating, and a few years down the line and you actually stop, you forgot and didn't update it, and you die while your ex-girlfriend is listed as a beneficiary on your life insurance, believe me, the insurance company is going to honor that contract and pay that money to the person that is listed as a beneficiary. They're not going to dispute that this is an ex-girlfriend. It's not their right, it's not their place to decide like that. They're going to honor your wish. So all I'm saying with this question is, please make sure that you're updating your beneficiary regularly, making sure that the people that are there are a true reflection of what you want to happen in an event that you're no longer here. Yes, that brings us to the end of question 5. I still have two more knowledge quizzes to debrief, and then I will move on to the home loan video. But I might just bring up the home loan video first, because a lot of you guys are actually asking about it. Thank you so much for joining us today, and if you haven't done so, please consider subscribing if this is the type of question that you'd like to actually engage in. And please don't forget to follow us on Instagram so that you can participate on our Knowledge Check Quiz Friday, so that we can actually see where you stand with your financial knowledge. Until next time, it is goodbye, and please stay safe.